Alrighty, stock options. This is a topic that I've been wanting to do for a long time because I always get questions about it and I never do a good job answering it because it's a complicated topic and it's got a lot of different angles to it, and I kind of have to fill in some background information first for everybody depending on who I'm talking to, and I don't know, it's just I always kind of leave people scratching their heads, so I wanted to just get it all out in an organized way. So, first of all, what is a stock option? Essentially, it's just it's a contract which gives the person holding the stock option the option to buy or sell a particular stock at a particular price within a particular time frame. Now, why would somebody want a stock option? Well, let me give you an example. Suppose that a stock, XYZ company, is currently trading for $10 a share. You have a stock option to buy that stock for $5 a share. Does that options contract have value? Well, sure. Yeah, who wouldn't want something that allows me to buy something for half of what it's normally trading for? I could buy the stock for $5, sell it right away for $10, and make myself an instant profit, right? $5 per share. So that's kind of obvious. But what about an out of the money stock option? Suppose the stock is trading for $10. Why would anybody want an option to buy that stock for $11 when they could just buy it for $10? Well, remember the stock option gives you a time frame too. So suppose you don't have enough money to buy a lot of that stock, but you can buy a stock option to buy it at $11 for a relatively reasonable price. Well, if there's enough time, you figure, well, yeah, I mean, sometime in the next year, if you buy a stock option a year out, you figure that stock's going to go up above $11. Then that stock option is going to start to have value, and you can exercise it, and you can make yourself a nice profit. You can really leverage the amount of money that you have invested. However, if the value of the stock never goes up above $11, then you'll never have the opportunity to exercise that stock option, and it's just going to expire worthless. You're going to lose all your money. So it can be really quite a risky proposition. But these contracts, they trade on the market, and the free market is what gives the stock options their value. Obviously, an option to buy a stock for $3 is going to be worth more than an option to buy the stock for $7. The deeper the discount is, the more instant profit there is. And then remember, there's also going to be some time value on top of that. So how do we play the options? Well, first thing you have to know is that stock options, one option, it gives you the option to buy or sell 100 shares. So remember that one contract corresponds to 100 shares, and that's a little confusing because if you're looking at the prices of stock options, you got to multiply everything by 100 to figure out how much it's actually going to cost you. But just bear that in mind. Another thing you should know is that because stock options can be so risky, it's very easy to lose all of your money. You might need to have special permission from your stockbroker. It's almost kind of like applying for a loan. You have to write how much money you have and how long you've been trading options and so on and so forth, and you'll get approved, or you'll get declined. They'll say no, we're not gonna let you mess with stock options. You'll lose all your money. So keep that in mind. Now, there's two kinds of stock options. You've got what are called call options, which give you the right to buy a stock, and you've got put options, which give you the right to sell the stock. And for call options and for put options, you can either be the person buying the option, or who's he buying them from? You could be the person selling the option. So you can buy the option to buy a stock, you can buy the option to sell a stock, you can sell the option to buy a stock, or you can sell the option to sell a stock. So that's why stock options get a little complicated. But let's just focus on a couple of easy examples. Suppose a stock XYZ company is currently trading for $10 a share, and you just know you've got a feeling, you've got a gut feeling that it's going to 50. You know the stock is going to take off within the next 12 months. What you could do is you could buy the stock, which you'd make some money on. Or if you really wanted to leverage yourself, what you could do is you could buy an option to buy that stock for $20. Right now it's trading for $10. Nobody thinks it's going to 20, let alone 50. So you could buy that option real cheap, right? And nobody's going to really have any qualms about giving you an option to buy it for 20. Right now it's only 10. So maybe it'll cost you, I don't know, maybe it'll cost you $5 to buy that stock option. And then if you're right, and that stock just takes off, suddenly it's a $50 stock. You exercise that option, and that can happen anytime within that 1 year time frame. So you exercise that option. You buy the stock at 20. The stock's now trading for 50. You sell it right away. You make an instant $30 a share, multiplied times 100, because remember, we got to multiply everything by 100. You just made $3,000, and it cost you virtually nothing to get into the game, to buy that stock option, because back when it was trading for 10, everybody thought you were nuts. But likewise, the odds of that happening are pretty slim. So chances are, more likely than not, you're going to lose your money. And that's what I like to do. That's the way I like to play it. I like to take advantage of all the people that are playing that speculative game. I like to be the one selling the call options. So what I would do is, let's take XYZ company. It's trading for $10. And it's a good company. I know it's a good company. I've done my research. I know it's going up, but it's I figure maybe it'll go up 15-20% a year. It's not going up to $50 a share. So what I'm going to do is I'm going to say, well, this guy here is willing to buy an option for $20. He's willing to give me money for the option on the off chance that this stock's going to go over 20. Well, I'd be happy if it goes to 20. I'm in at 10. If it goes to 20, I still doubled my money. I'm more than happy. I'm set. And he's going to give me money on top of that just for the option. So I'm going to be the one selling the option to him to buy that stock at $20. And I don't know what the number is. 90, 95, 98, 99% of the time, those options all do expire worthless. And I'm just going to keep his money. So that's what we call a covered call. Instead of just having a naked call where I just sell him the option without owning the stock, that can get real dangerous. There's no limit to the amount of money I can lose there. But if I already own the stock and I give him the option to buy it at a certain price, I'm guaranteeing that he's not going to make any money unless I'm also making money. And guess what? What if the stock actually goes down a little bit? I could still be making money because he's still paid me for the contract. So it's actually safer than owning the stock outright. It's crazy stuff, but it works.